Well, SoFi has just been on a tear and it's been a great run. I mean, even all the folks who were saying it's going nowhere back at the beginning of the year are now back to pumping up the stock, and the stock has just been on a rocket ship up as SoFi continues to click on all cylinders and Wall Street is apparently behind it. But guys, I do have one big problem with SoFi I have to share with you guys today, and I'll tell you to solve it as well. Don't worry about that. I'm not going to, leave you guys out in the dark or leave you out to dry like that. I'll tell you exactly how to solve it. And I'm also noticing some massive misconceptions about SoFi that lead you guys to disaster. So we will discuss those two since you may have them in your mind, and it's going to get you wrecked sooner or later. Just make sure you like the video if you like getting the truth without the hype, because that is exactly what you're going to get today, guys. Thank you very, very much for those of you guys that hit the like button early. It really does help out the channel a ton. Okay, so the ride with SoFi has been just crazy if we're being honest, right? I mean, the bulls and the bears are crazy about this stock. Basically, you got the bears saying it's just a bank and it's complete junk with absolutely no moat, and they just go on and on and on about things that just factually aren't even true. And then over here on the other side, you got the bulls saying it's going to $300 soon, then flipping to Noto's the worst CEO ever and they're just going nowhere, and he doesn't tweet to us as retail investors, therefore it's a bad company and doomed to fail. And then now they're back to flipping back to massive run coming, best CEO ever, and on and on and on. It is just manic craziness around this stock just this year. But guess what, guys? None of that bothers me at all, and it probably doesn't bother a lot of you guys out there, especially a lot of longtime followers of this channel. Basically, if you want to see crazy, see Tesla for an even crazier ride if you want a crazy stock to follow. And in our group, I bought SoFi more than 100 times, well under $10 per share, which I may have left something special for those of you guys interested down there in the pinned comment, but we'll talk more about that at the end. But this one problem that I have with SoFi has burned investors over and over again. But don't worry, there's a way to solve that problem as well. But let's discuss those misconceptions first and kind of get them out of the way. But boy, are they bad? And I'm starting to see them more and more often all over the place. Now, to be clear, guys, this is not a criticism at all, guys. I'm not. I'm trying to help you guys, but it is something to be aware of. And more importantly, not fall into these traps and misconceptions. That's all that this is intended to be. So please don't take offense to it. By the way, I have done all of these before. So that's the reason, and that's kind of where my knowledge comes from, is from making those mistakes over the 25 plus years I've been investing in the stock market. That's pretty much where this lessons have come from. And it may not be SoFi either, guys, just to be upfront. It may be other stocks that you love that you might be applying these things elsewhere. So you might not be applying it SoFi, might very well be applying it elsewhere. So kind of think about all your stocks as you're kind of going through these lists. But let's get better together here by starting with the first misconception, which is SoFi won't be volatile anymore. As if volatility stops the moment the stock hits a certain market cap, right? I mean, I don't know. I mean, maybe now the traders see that Noto is serious and is a great CEO, so they're going to back off, right? I mean, no, that's not generally how it works. And the reasons commonly given as to why it won't be volatile is something like, it's a great company, which I agree. It is a great company, but that's it. And if it's a great company, then therefore there's no more volatility in the stock. It's just not how it works. And more importantly, was SoFi not a great company 10 months ago when we saw it run up from $6 all the way up to $18, then all the way back down to $9, all in the span of like 4 or 5 months? I mean, it was a great company then, and yet that's the exact volatility I'm talking about. That's the exact roller coaster it went on. So yes, SoFi is a great company, but being a great company has zero to do with volatility, unfortunately, guys. I'm sorry. And one of the other reasons that's given is it's the fastest growing bank and it has super high growth and they're dominating, or something around that nature. Well, guess what, guys? Fast growth typically means the opposite. It means more volatility. Boring, low or no growth type companies typically bring less volatility. High growth and a stock that is on a 3x run from the lows just 5 months ago usually means more volatility, not less. And by the way, guys, volatility applies to both the up and the down cycle. So a 3x in a few months after a 50% haircut the prior few months is the very definition of volatility. Another reason given, and it's partially true, but partially not true, is more institutional ownership. But just for context here, Tesla has more institutional ownership than SoFi does. And I'm not sure if there's a stock more volatile than Tesla, right? And it's a freaking mega cap stock, unlike SoFi that's not. I mean, Elon could buy SoFi tomorrow, no problem, and have it not even really affect his net worth overall. So if Tesla can be volatile at the market cap size that it is, it absolutely can be volatile at the market cap size that SoFi is. And also keep in mind, there are different types of institutional ownership, and that institutional ownership matters a lot. Do you have the same mix as Apple in terms of institutional owners? Or is it closer to Tesla's? There are some institutional owners that rarely sell the stocks, and others who sell and buy all the time. The mix and type of institutional ownership matters, and I doubt most people commenting on this have deep dove the individual ownership mix to see what type of institutional ownerships are actually around SoFi. SoFi is also still early in its journey, and it will continue to remain volatile in the coming years, in my opinion. Now, here's where I kind of agree with the take a little bit. It's not going to be as bad as before. I would agree there, but it's also not going away completely. Now, should the volatility continue to subside as they execute? Yes, absolutely it should. I would agree again completely there. But that is a multi-year journey, not something that happens in a few months, especially after a massive run. You don't go from highly volatile at the beginning of the year to a low volatility stock at the beginning of the year. It's just not how it works, guys. Well, maybe SoFi is the exception here, but I don't like counting on exceptions in my investing. That's how you end up losing over the long run. And the second misconception is taking profits beats holding. Now, statistically, across the board, that is not true. The studies have been done by Wall Street, the very people who would take profits and trade, and they say it's not true. The greatest investors ever all say that it's not true. And we even back tested it in our group, and guess what we found? It's not true. Even when you try to make it true, you just can't do it. But yet, some of us out here as retail investors, hopefully not the folks watching this video, but some of the others say that it absolutely is true. And of course, they say it's easy to see when to buy, when to sell, and then when to buy the dip. And of course, they talk about the past and all that good stuff, which always looking backwards is called hindsight. And hindsight is the biggest deceiver in investing. If you could actually make the same trades you see in hindsight, there would be trillionaire investors. But guess what? There isn't any trillionaire investors. Taking profits is a trader's move. Now, let me be very, very clear before you guys go blast me down in the comments. It's not wrong at all. If it's a planned trade, it makes perfect sense to me. If your bonus is dependent on it, it makes sense, right? That's why Wall Street takes profits, because they only get paid when they do. That is what their bonus is dependent upon. So if that's you, it makes perfect sense. If your plan was to sell at a certain price to fund retirement, maybe pay off a house, pay off a car, buy some cash flowing real estate, buy another asset, start a business, whatever the case is, that makes perfect sense. And I agree there completely. And also, if it was just simply a planned swing trade and SoFi hit your sale price, of course, makes perfect sense right there to take your profits. But if you're a long-term believer in SoFi and you want to hold it for the long term, but you simply trim to trim or lock in your gains, or because you can just sell and then just buy the dip leader and rinse and repeat and get more shares and all that other silliness, that's what it is. It is statistically over the long run just silliness, and you will underperform over the long run those that just buy and hold and add on the dips. Now, short term you may outperform, but long term it doesn't hold true. Now, let me also be very clear. I'm not saying never take profits, but it only makes sense when it fits into your plan, your goals, or if there was a fundamental change in the business, which, if you're tracking the earnings calls, reading over the financials and all that good stuff that we talk about, and doing that every single quarter, not just every once in a while, you will know exactly what is going on, exactly what you own, and it's easy to know if there is ever a problem and you need to then sell and move on. That way you're not writing it all the way back down like some folks are saying. Never happens if you're paying attention and doing your due diligence. Now, if you're not doing that deep due diligence all the time, every single quarter, and instead you're watching YouTube videos and social media posts or doing other things, then you are going to make many, many mistakes over the long run, because that is part of owning individual stocks, is putting in that work. But there is something else that has plagued this stock since it went public, and it is the big problem that I have with this stock, and don't worry, there's a solution to it too. So what is the big problem? Basically, this stock goes on a hype run after a hype run, creating a ton of FOMO, a ton of noise, a ton of everything, and situations where people get caught up in it, only to see it to completely crater back down to some crazy level. And unfortunately, you're left holding the bag. Basically, it rocketed up to, I don't know, $20, $25 or so immediately after going public, right? And then it fell and then ran up and fell down more and ran up and fell down more, rinse and repeat for more than a year, all the way down to $4. And none of those runs or the drops were fueled by anything other than hype and negativity and a lot of other things. It had nothing to do with the performance of the business underneath. And then they have turned their way around to profitability, which was a real catalyst for the stock. But instead of, going to the moon, it got a hype bump up and then it cratered back down again down to like $6 or something like that. And then obviously earlier this year, Noto is the best CEO ever and it goes up to almost $20 again, only to fall all the way down to $9. And now Noto is the worst CEO ever. And that right there is my big problem, is that SoFi seems to go on a big run up, a fall down big on nothing, while the performance underneath stays just as steady as can be. But when it has those big runs up, the bulls will come on saying the moon is next and $100 per share is undervalued today and all kinds of stuff like that. And then people FOMO in. And then when the stock price falls and the hype falls down, then the bulls kind of get negative and you end up with a lot of bag holders out there making that classic, mistake that we've all made in the past of buying high and selling low. So how do you solve this problem so it doesn't happen to you again with SoFi? First, ignore the noise, both good and bad. Because we know it, guys, both the bears and the bulls have been incredibly wrong about this stock. Some have switched from bull to bear and vice versa. I mean, all that sort of stuff has just happened, right? Bulls have been ultra bullish, then ultra negative, and I don't know. It just seems like all over the map. Somebody loves SoFi, gives them a huge upgrade, gives them 5 upgrades in a row, then all of a sudden they don't give them any upgrades and they're downgrading them all the time. I mean, you just can't make this sort of stuff up. It's just ridiculous. For me, I simply ignore the noise, get into those earnings calls, listen to what the management team is telling you, and move on with life in regards to this stock, because there's a lot of noise, both good and bad, around it. That's very, very compelling in a lot of ways. Thankfully, there's some very good people in the SoFi community putting out great content out there. I would agree there completely, so it's not across the board. But man, has it ever been a wild ride, especially this year with SoFi stock, to where if you just simply ignore the noise, man, you were having a field day like we were in our group whenever it fell back down to $9 again. It was just like, this is silly. Like, what the heck? I'm loving this, right? I'm going to pick up a lot of extra shares right here and going to make a lot of money. I didn't know I'd make, I'd 3x my money on those shares, just a little bit later. But hey, maybe I was lucky, but luck is just simply where opportunity, SoFi at $9, meant preparation. I was ready to pounce, had the money ready to go, and bought the shares. Second, stick to your plan. If you are DCAing into this stock, just keep going. Price movements shouldn't change your DCA strategy. Then you're not doing a DCA, right? That's the whole point. You're going to, if it's $500 DCA every month, hey, great, you're buying $500. Whenever the price is higher like this, you're going to be able to buy less shares. Whenever the price is low, whenever it's like $9, you're able to buy a lot of shares. But either way, that's how you end up with a lower average overall over the course of a DCA. But either way, if you're DCAing, just keep right on going. We're not at some crazy, ridiculous valuation right now. It's definitely red hot, but nonetheless, trying to guess when it's going to stop, when it's going to start. Should I stop my DCA? Should I start? That's not the point in the DCA. The point in the DCA is take those emotions out, buy it on the schedule, and move on, understanding that it's incredibly hard to beat. And those of you guys out there that are just simply long-term holders in this stock, just simply because it's running red hot, don't start trading because it looks easy. Don't start trading because people start drawing lines on the graphs and gaps here and all this other stuff like that. That sometimes is true, sometimes is not true. The point being, if you're going to trade, have a trading strategy, which is very, very different than being a long-term holder of the stock, and understand you're going to underperform over the long run. All of us that are just simply trying to accumulate as many shares as we can over that same time frame, that's what the numbers say. So if you're a long-term holder, don't start trading because it just simply looks easy, because everybody's telling you it's easy until it's not. And more importantly, you end up deviating from that plan that you laid out without emotions and everything else, and you're coming over here now. So if you're going to do that, it needs to be very deliberate, very planned out, and then at that stage, you can execute to it. Maybe there's a reason behind it. I'm not here to judge either way. Just simply telling you guys, don't fall into that trap of thinking trading is easy and then trying to do it, because that always happens in markets like this. And third, create a valuation so you can tell hype from opportunity. It is impossible to know if you're overpaying if you don't do a valuation, guys. That's just bottom line. That is so basic and fundamental to what we do. That's why I talk about valuation all the time on this channel. It is how you avoid buying SoFi at $25, 4 years ago, and instead you were just gobbling up shares like crazy in that $4 and $5 range, right? Yeah, it's nice getting a 3x on those $9 shares. Man, you're almost, you're getting close to a 10x now. If we start approaching 40, on those other shares that you bought right down there in the $4 range. That doesn't happen if you don't do evaluation in the first place. You have to learn it. It is so critical. Guys, you don't have to join our group. Go right up here in the YouTube search bar, Google it, ChatGPT it, whatever the case is. You have to learn it. And of course, if you stuck around this long in the video, I may have left something special for those of you guys that want to learn it from our group, where we do that through courses, through free coaching, through live Q&As, through the best 6, 7, and 8-figure Discord out there with some really great investors out there helping you become a better investor, giving you that community you need to lean on, where we care about valuation. We don't care about hype. We're trying to eliminate that. Get into those valuations, get into those fundamentals. If that appeals to you at all, I may have left something special for you down in the pinned comment. Check it out and see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and I'll see you in the next one.